Hey, it's Tom here and welcome back to the channel. So in this video, I want to talk about book value, sometimes described as equity, and ratios such as the price to book ratio. So taking the price of a company, dividing that price by its book value or equity in order to give you some sort of ratio. Now, this is a metric that really old school value investors used to focus on quite a lot. So the likes of Ben Graham, Walter Schloss, Rick Guerin, even an early Warren Buffett or Charlie Munger. These are all investors who focused very, very strongly on book value and tried to buy into businesses that were trading at deep discounts to their book value a lot of times. But in more recent years and in recent decades even, these investors have really started to kind of veer away from using book value as a way to describe the intrinsic value of a company. Many modern value investors will even pay many multiples of book value, which would be kind of unheard of for some of these older school value investors. And I want to basically cover the topic in this video of whether book value is still a useful metric in some cases, or whether it's now just a complete waste of time. And the short answer to that question basically is sometimes it's still very useful and sometimes it is a complete waste of time. And I want to kind of talk through what kind of things you may want to consider around whether you see book value as being an important metric when you're valuing a business, and some of the types of businesses where book value really is not important. So that's the topic for this video. If you do enjoy it, please hit like and hit subscribe. But for now, let's get straight into it. Now, first off, let me give you a very quick and easy example of basically what book value or equity kind of is. Basically, at a high level, book value is simply the assets of a business minus its liabilities. So if you own a property, for example, if you own your own home, you would take the price of that home, let's call it $500,000, and let's say you have a $300,000 mortgage. $500,000 minus $300,000 is $200,000. So that would mean that you have $200,000 in equity in that particular property investment. Now, same kind of idea for businesses. We basically look at the assets that were required to set up that company, subtract any debts, a few other kind of adjustments happen around the edges, but that's at a high level what's happening, and that gives us an equity or a book value for that company. And like I say, old school investors were trying to often buy into businesses at a discount to book value. So if they could find, that property investment, for example, trading on the stock market, and they were able to buy that $200,000 of equity for only, say, $100,000 in the stock market, in per share terms and all that sort of stuff, they would find that that is, an attractive investment. You're buying into that property at substantially less than it's really worth. So that's just an example of where book value can be quite useful, and that's kind of the way that some of these older school investors were thinking about it. But like I say, with a lot of more modern businesses, book value is really not that useful. And I want to give you kind of a Warren Buffett analogy on how he explained book value in the context of a couple of university students, and where book value in this example doesn't necessarily tell you what the true intrinsic value of the businesses, or in this case the students, is going to be. It doesn't really describe what the future cash flows of those particular individuals or of the particular businesses that you're looking at are really going to be. Now, if you use that Warren Buffett analogy, basically he talks you through two students, and he says that each of these students both go to the same business school. They both spend, let's just call it $50,000 on their education, which basically means they have a book value of about $50,000 if you were to think of them like a business. Now, the obvious thing to consider here with these business school students is the amount of money that goes into their education clearly does not describe how much they are likely to earn into the future. Sure, we can look up what the average business school student goes on to earn throughout their career, but if you're just trying to pick one individual, there's going to be wide variations in how much those individuals earn throughout their lifetime. So we could have one student that goes on to be super successful, they move up the ranks in their corporate job, or they start their own business, or whatever it might be, and they have an enormous income out into the future. And if you were to sort of invest in that student, you would do very, very well, and you can maybe even pay multiples of that book value or that $50,000 if you were to get a share of their earnings for the rest of their life and still do very, very well. But on the other hand, you could have a student that, spent $50,000 on their education and then maybe just decides to never get a job and lives on unemployment benefits and stuff for the rest of your life. In which case, even if you were to buy into that student at sort of a discount to their book value or that $50,000 that they spent on their education, you probably wouldn't get the best result if you had sort of a share of their future earnings as an investor in that sort of student business. So that's a really nice analogy that I like from Warren Buffett when it comes to assessing how important the book value is for a particular business. So there are certainly cases where it is still useful. Basically, it all comes down to if you're buying into a business where the amount of money that that company earns is basically directly related to the assets that it has, book value is still going to be quite useful. So real estate, like we talked about earlier, is a very, very good example of that, where it's really hard for that particular business to earn a higher rental income if it doesn't have more real estate assets, right? If it doesn't have, more square footage and goes out and buys, other real estate assets, or maybe it's doing some sort of redevelopment like a Heritage Growth Properties in order to grow its square footage and grow the amount that, those individual square feet can be rented out for. So if you're in a business like that where it's highly dependent on the amount of assets, that really dictates how much cash flow the business can bring in, then book value is quite useful, and buying those businesses at a discount to book value can be quite a powerful way of investing. So real estate is an obvious example. Something like banking and insurance is quite a good example as well, where really in order to bring in cash flows from those types of businesses, you have to have some sort of asset base in order to, lend as a bank, and in order to insure, large insurance policies and a number of insurance policies if you're an insurance business. So with those types of companies, using book value can be very, very useful. But it's becoming more and more common that we have a lot of businesses where book value isn't particularly helpful. And you can actually afford to pay large premiums to book value and still get a good return. So Warren Buffett's investment in Apple is a good example of that, where, Apple obviously has a certain amount of money invested in physical assets that would go to their book value or the equity. They'll also have some intangibles, things like goodwill and so on, that all flow through to shareholders' equity. But really, they earn massive returns on shareholders' equity. I'll put up a screenshot here of the returns on equity from Apple, and you'll notice that the returns on equity are huge, because really, it's the power of the brand and being able to sell products at a premium price which really drives the earnings for Apple. And if they were to go out and build a new factory and double their physical assets, that's not necessarily going to correlate to more earnings power for Apple. The amount of cash flow that business can bring in is really detached from the physical assets and book value that company has. So Apple is a really good example, and there's countless others. Things like Google is also a good example. Facebook's a good example. A lot of these sort of asset-light businesses that earn very high returns on equity often have brands attached as well. These are the types of businesses where you can really afford to pay oftentimes many multiples of book value, and book value is probably not a particularly useful metric when you're trying to come up with an intrinsic value for those companies. But of course, that does not mean you can pay an infinite price, and a good example of that again comes from Warren Buffett, and actually one of his poorer investments, which was his Kraft Heinz deal. Now, when you hear Warren Buffett talk about the Kraft Heinz investment, he basically says he overpaid for it. Now, Kraft Heinz is a phenomenally good business, and again, this is coming straight from Warren Buffett, where they have about $7 billion in tangible assets, and they earn about $6 billion pre-tax on those assets. So massive returns if you were to look at it on a book value basis or on a tangible asset basis. But that is not the rate of return that Warren Buffett is able to get. He wasn't able to buy into Kraft Heinz for the $7 billion of book value that they have, or the $7 billion of tangible assets that they have. In fact, he paid over $100 billion. So in order for Warren Buffett to get a good return, Kraft Heinz has to earn a good amount of money on that $100 billion base that Buffett paid. So he paid a massive multiple of book value, which is probably justified because the business is so good and it earns such a high rate of return on its capital. But nonetheless, he kind of has to earn on that higher base because that's simply the price he paid. You can buy into these great businesses with high returns on equity and high returns on invested capital, but in order to actually get a good return, at the end of the day, they do have to earn a good amount of money on the price that you paid. Now, one of the other things to keep in mind is there are a few drawbacks to using price to book. Now, if you do come across one of these businesses which is quite reliant on its assets in order to grow its earnings base, and book value might be quite a useful metric, there are a few things to keep in mind. So Berkshire Hathaway is actually a pretty good example of this for a couple of these things. So Berkshire Hathaway obviously is a company, again, owned and kind of run by Warren Buffett, where they have continued to acquire new businesses over a period of time. And you may have heard Warren Buffett talk before about potentially buying back stock at anything under 1.3 times book value. So he's willing to pay a premium to book value. And a lot of people kind of wonder why that is the case. When he acquires business for, say, $1 billion, just as an example, that will then go on the books at $1 billion in book value, right? So why would you then go and pay a premium to that $1 billion? Well, basically it's because of this. Now, over a long period of time, Buffett has clearly acquired a lot of businesses. Some of them have worked extremely well and some of them have worked quite poorly. Geico is a good example of a business that has probably about tripled since Berkshire Hathaway took 100% ownership of it in, I think, the 90s. I'll put an exact date up on the screen here, but I think it was about that time. And in terms of how that's reflected on Berkshire Hathaway's balance sheet, basically Geico is a business that has never been re-rated on Berkshire's book value. So although the value of Geico's business has clearly grown a lot, that has actually never been reflected on the balance sheet at Berkshire. And for that reason, Buffett is actually quite comfortable paying a premium to book value, because although he's had some businesses not do so well, the ones that have done very well have kind of outweighed the ones that have done poorly. So over time, this sort of premium to book value does become justified. Now, the other thing you may find with some companies is that they don't actually have a book value, and that when you first find it can be kind of a really obscure concept to try and wrap your head around. So often this doesn't actually happen with the companies where book value tends to be useful. It tends to happen with these kind of more asset-light businesses where they're able to run the business with very little capital, but nonetheless I'll explain kind of why that's happening. So I'll give you a couple of examples here. If you were to go and look up on Yahoo Finance, for example, McDonald's, or the tobacco company Philip Morris, these are both businesses that actually have negative shareholders' equity or negative book value. And on the surface of things, that sounds kind of strange. You know, do they like have a bucket load of debt, or what's kind of going on here that's driving this negative book value? And of course, that makes things like return on equity calculations basically impossible because they don't have any shareholders' equity to kind of earn a return on. The shareholders' equity is therefore infinite, you know, if they don't have any equity or if they have negative equity. So what's going on here? Basically, anytime that a business buys back shares, the amount of money that they spend on buying back those shares goes on to a calculation on the balance sheet for that business under treasury stock. And treasury stock is sort of a negative value when you calculate the shareholders' equity. So if you spend $1 billion on share buybacks, for example, that will actually reduce the shareholders' equity by about $1 billion. That's kind of the way that it works accounting-wise. And basically, both McDonald's and Philip Morris are companies that have just bought back stock very, very consistently over a long period of time. So when they first issued stock, they had a certain amount of shareholders' equity, you know, decades ago, and they've slowly bought back stock at actually a large premium to the price at which they issued it many decades ago. So as you buy back those shares and you sort of retire those shares, I guess, in a way to increase the per share ownership that each remaining shareholder has, that results in a lower sort of total shareholders' equity on the balance sheet. And Philip Morris and also McDonald's are kind of extremes where that has happened over a long period of time, and you'll actually see that the shareholders' equity is now negative. So if you're wanting to do a real sort of return on equity type calculation for those businesses, you could manually go in and add that treasury stock kind of number back to the shareholders' equity and try and calculate it from there. This is actually something I read about recently in Warren Buffett and the Interpretation of Financial Statements, which is a thrilling title, but it's actually a pretty good book if you want to learn a bit more about accounting. So it's an interesting one to keep in mind, and it doesn't necessarily mean that the business is kind of laden with debt or anything if you do come across those negative equity values. So to sum this whole thing up, yes, book value can be useful from time to time, but with more modern businesses, more capital light businesses, and companies that have strong brands and earn very high rates of return on capital, book value is potentially a far less useful, potentially even useless kind of metric. So I think it's an important one to understand because for a long time it was a very key component of valuation, but it's becoming clearly less and less important. So I do hope you enjoyed the video. If you did, please hit like and hit subscribe, and I will see you in the next one. Cheers.